Forget price charts for a second. What if the boring, unsexy part of crypto actually made you more money last year? That's not a hypothetical. For a growing number of investors, staking rewards quietly outpaced every rally, every dip, every breathless headline about the next 10x. We're talking about yield, real, compounding, show up every epoch yield. And in a year where price appreciation was more of a suggestion than a guarantee, some chains were just printing passive income, while everyone else was refreshing CoinGecko at 2 in the morning. Think of it like owning a rental property in a neighborhood where home values flatlined, but your tenants never miss rent. Now, to understand why this matters, you have to zoom out a little, because staking isn't magic, it's a mechanism. Proof-of-stake networks pay validators and delegators to lock up their tokens and secure the chain, and when prices don't move, that yield percentage suddenly looks a whole lot more attractive in your portfolio. Last year was genuinely weird. We started 2024 with ETF euphoria, Bitcoin dominance climbing, and the altcoin season that everyone swore was coming any day now. Spoiler alert, for most coins, it didn't quite arrive the way the influencers promised, and that's exactly where staking stepped in as the silent overperformer. The psychological toll of holding through sideways price action is brutal. It's like watching paint dry while your neighbor tells you he turned $40 into $40,000 on some dog-themed token. But here's what the disciplined staker understood. Yield doesn't care about your feelings, and it compounds whether you're watching or not. Historically, every major crypto cycle has had an asset class that quietly wins while everyone chases the headline number. And in 2024, yield-bearing positions were that quiet winner. Cosmos ecosystem chains like Cosmos Hub were paying somewhere around 14 to 19% annually in staking rewards, which means you were getting paid generously just to believe in the network long enough to lock your tokens. Celestia, one of the newer entrants, was offering staking yields north of 15% at various points throughout the year, which is the kind of number that makes your traditional finance friends suddenly very interested in this space they claimed was dead 6 months ago. Injective Protocol was similarly aggressive, with yields that rewarded early believers while the price chart did its best impression of a shrug emoji. Now, let's be honest about the misconception that trips everyone up high staking yield does not mean free money. Because if the token's value drops 30%, your 18% yield is a consolation prize, not a win. The chains that actually delivered net positive returns in 2024 were the ones where staking yield combined with price stability or modest appreciation. And that's a much shorter list than the yield percentage. Leaderboard suggests Ethereum, the grandfather of proof-of-stake respectability, was offering a more modest 3 to 4% staking return, but paired with institutional demand and relative price strength, it was the tortoise in a race full of flashy hares. Solana sat somewhere in the 6 to 7% range. And given its price performance during stretches of 2024, stakers were genuinely being rewarded on both dimensions, which is the dream scenario. The lesson history keeps trying to teach us, and we keep having to relearn, is that total return is the only number that matters, not the APY on the banner ad, not the Discord announcement, not the back-tested simulation from a bull market. Your actual return is yield plus or minus price change. And building a staking position without understanding that is like buying a rental property without knowing the neighborhood's vacancy rate. Practically speaking, if you're going to allocate to staking, size it like a bond position in your broader portfolio, not a lottery ticket, not your entire stack. Diversifying across 2 or 3 chains with credible validator ecosystems, reasonable lockup periods, and genuine network utility gives you exposure to yield without concentrating your bet on any single protocol's survival. The deeper irony here is that the most boring staking strategy, pick credible networks, stake consistently, reinvest rewards, don't panic unstake during drawdowns, would have beaten most active trading strategies in 2024 without a single dramatic moment. Discipline is genuinely the edge, and almost nobody wants to hear that because it doesn't make for a great story. There's something almost philosophical about getting paid to wait. Staking rewards are the market's way of compensating you for conviction and patience, 2 traits that are genuinely rare in a space built on dopamine and narrative. The chains that paid you the most to believe in them last year are also, not coincidentally, the chains that had real validator ecosystems, real developers, and real reasons to exist. So whether prices rip this year or spend another 12 months testing your emotional fortitude, your yield just keeps accumulating in the background like a slow but very reliable drip. The position size you choose, the consistency of your reinvestment, and your ability to ignore the noise will matter far more than picking the single highest APY chain on any given Tuesday. And if you're ready to take that same disciplined, yield-focused mindset into building real wealth outside of crypto through real estate investing, home contracting projects, or finding the right lenders to make your next move, check out our links in the description below.